Hello guys, in this set of videos of lessons we try to see the topic of IPOs. Okay, we try to see what is an IPO and how to trade them and why we are interested in this kind of stocks. Okay, so let's begin with what is an IPO. So an IPO, the abbreviation is initial public offering, is a new company that gets listed in the stock market. It means, in order to understand this IPO, we try to look why a private company goes and becomes public company. We see the difference between them. An IPO is just a company that was private, okay, and it wants to be public. So from private company to public company, how it goes from private to public, there are a procedure. So the company asks the exchange or the stock market to get listed. So they ask this company to do a lot of things. For example, to file all the financial information about the company. But before we go to that this company becomes public, we try to see the private company. It means before it goes to the stock market. You know, any company begins small. Now, when it becomes small, it is private. Private, it means one person or two people or three people or friends, they have some money and they create a store or a business. Okay, they sell something or they do a service like a mechanic, or they do whatever service they want to do, and this is their private company. It means they work hard in order to make their business bigger and bigger and bigger. Now, if you you are an investor, okay, most of the time private companies they don't sell their companies. They don't sell when they are small. Some they do, okay, to bigger companies. But at the beginning, most of the companies, especially if they are successful, they don't sell because they see a potential that their company is private. It is a small, as I can see here. Sorry for handwriting. If they become public, they become big company. And I will explain this into details. Now, if you you want to buy shares of this company, 100 shares, 200 shares, when you call them, this company, and you say, okay, I want to buy some shares because I see your company is doing good, so you can't buy. This is the first thing. They will not sell to you. Because why do they sell to you and they are successful? They are making money. The problem, if they are having debts or they have problems, yes, they need help. But when they have money and their company is doing good, they don't need help. So most of the time they don't sell to strangers, because anyone who is outside the company is a stranger. Now, second, you can't vote. Okay, since you can't buy shares, you can't vote. This is automatic thing. You are not inside. You can't change the CEO of the company. You can change the executives because they own this company with their money. So you can do nothing. Okay. Now, number three, number three, you can't access financial information. You don't know how much these guys are making. Even if you want to know and you search online, you don't find, because it is not public. For example, you have a friend, let's say, who has a restaurant, and you see that his business is doing well. Without asking him the question, how much you make each month or each year, if you are going to search for certain information, you will never find. Okay? So because it is private, and these companies, they don't publish what they make. Yes, they give it to the government with the IRS. The IRS knows how much this company make because they should pay tax, which is obvious. But anyone else can't access information. The number four, you can't see the shareholders. It means you will never know who is with this company, who are the big shareholders or the big owners. Okay? It's like a private thing. If you go to your friend, he has a big restaurant, and you say, "Who are your who are your owners? Or who are the owners?" He sometimes they don't give this kind of information. Maybe it is his wife or his other friends or his family or whatever. So they don't share this information, which is normal because it is a private thing. Another five, you can see executive salaries. It means since they have a company, it's a private, they should have salaries or paychecks. So these salaries and paychecks, you can't see them and you don't know how much they make. You don't know how much the company make. You don't know your friend how much he make, and it's because it's private. Now, with the bonuses or the compensations, you understand that the executive can give to themselves whatever they like as money from the company. Let's say the company, they have small restaurant and it makes, let's say, $1 million each year. Let's say it's a good company making $1 million a year, and we have two guys, okay? They can take 200,000 a year or 300 each or whatever they want, okay? It is their company and they do whatever they want. So understand that. Now, this company, it's doing good, but sometimes companies, they don't want to have only one restaurant. They want to make bigger money. So if they go to the banks and to have loans, this is very difficult because even the loans, they don't give them that much and the company can't go very fast. So what they do, the only thing they do is they go to the stock market and they want to make their company public. But stock market asks that the company should give all the information, most of the information, financial information, to the public. Because when I and you and another guy, we want to buy these shares from the company, we should know, for example, investors, they ask that they know information about this company, how much the company makes, and how much the guys are taking, and the health. It means, is this company healthy, yes or no? So when this company accepts to give information, there are some procedures with the banks and the other things, and then let's say it becomes public. Now things change here when the company becomes public. Anyone can buy shares. It means you go to the stock market, let's say Facebook. Okay, you go to the stock market, you find Facebook at $182. You want to buy one share or 1,000 share or 1 million share. If you have the money, you can buy everything. You can buy whatever shares you want in the company, in the market, because they are there available. Anyone can vote. It means if you own the shares of this company, they send you a letter and they ask you can vote, okay, for executives or to change something. You can vote and you have the right to vote. Anyone can see even having no shares. It means for the financial information here, we are speaking about this financial information, anyone can see even if you don't have shares. You can go to Yahoo, to Nasdaq, to NYSE or any website. You can find the company and how much it makes, what is the debts, what is the loans, everything about the company. Anyone can see the shareholders. It means the big shareholders, mutual funds that they own this company. Because this company, when it becomes public, the first owners that they have the company, they can have, for example, 60% of the company or 50% or depends. But the other half, 50% or 40%, it goes to these big guys like mutual funds, like big guys in the market. You see their names or their companies. It means it becomes public. Now they don't show you someone who has owned 100 shares because it is not a big shareholder, because there are millions of these guys like us, like you, like everybody else. But they show the big guys because they are very, very important. Anyone can get an idea of how much executives make and get as a bonus because now they are public. Their information should be transparent. It means if the executive is taking 1 million a year, they should put this information to the public that he is taking that much money. Okay? Or if they have a big bonus, or if these guys are selling their shares, it means maybe the company has bad things. Okay? So this is what is an IPO, and this is why the small companies go and become big companies. Okay, and become public, and everything is in the benefit of the small company, because it will become the next day when it is an IPO, it becomes a big company because it will have more money from the public who are buying virtual shares, and this company will have a lot of money and it can grow and open other stores, and the future will be brighter than before. Okay, so this is all. So this is all for what is an IPO and how the small company becomes a big public company, and they get a lot of money because these shares are virtual. They have no value. Okay, let's say for example the company has 1 million shares before it was private. 1 million shares, okay? Now it has 100 million shares. 99 million shares, the value is nothing. But if you go to buy the company from the public, let's say it is $10. So all this money that comes, a lot of it go to the company as cash, because you buy with real money, not with your credit card. So this money goes to the company and goes to the big shareholders, okay, the big shareholders of the company, and the other shareholders from the market, the new ones, when the stock is public, the company is public. When you buy, you own shares the same as the other guys who own the company, but you own little and they own a lot. Okay, so in the next video I will try to explain something else about why people they buy these IPOs. Okay, so stay tuned and go to lesson 2. Thank you.